Hey guys, welcome to the channel. I'm going to be posting more YouTube videos, so make sure to subscribe. But in this video, I'm going to break down my 4 investment property portfolio I own as a 25-year-old and exactly how much each of these properties cost me and how much my total portfolio cost me a year to hold, which is by far one of the most asked questions that I get. So it's time to break it down. And if you've come from social media and already seen the breakdown on property number 1, you can just scroll through and fast forward to property number 2, 3, and 4. But if you haven't seen that video on my social media, that's okay. Let's break down property number 1 now and go through all the costs associated with this property. Property number 1 was purchased for $450,000 in Perth, WA in September 2022. The property in question is a 4-bed, 2-bath on 600 square meters, around 13 Ks from the Perth CBD. And if we go off some recent comparable sales, that property will be conservatively worth around $750,000 today, which is around $300,000 or 66.67% of growth in just under 3 years. If we worked out the growth rate per year, this works out to 21.88%, which is far above the average return of the Australian property market, which is 6.8% over the last 25 years, according to CoreLogic. Now, I went halves in this property with my dad, meaning that I own 50% and he owns 50%, both in our personal names. Now, the reason I mention personal names here is because my 3rd and 4th investment property have been purchased in different entities, company and trust structures, but I'll go into more detail about those later in this video. Now, the loan amount on the property is $335,000 and the interest rate is 6.45%. Now, let's get into all the costs associated with holding this property. So the repayments, first of all, cost around $1,800 per month, which comes out to $21,600 per year or around $415 per week. The insurances on this property, which are building and landlord insurance, come out to around $1,485 per year, which is $123 per month or $28 per week. The rates and water on the property come out to around $2,770 per year, which is $230 per month or $53 per week. The property management fees on this property is around 8.5% of the rent, which comes out to around $2,900 per year we pay to property managers to manage this property, which is absolutely essential as an interstate investor because I live in Melbourne and the property's in Perth. This works out to $243 per month or $56 per week. We've also included a maintenance buffer of around $500, but we haven't had any maintenance on this property in the last 12 months. We do have larger buffers in place in case anything does go wrong, but for calculations, we've included a $500 figure just so you can see. This works out to $41 per month or just under $10 per week. Now, we haven't included land tax into the calculations here because we haven't included the money that we get back at tax time for holding this property, because you can claim on things like maintenance, the interest on your property, all of those things that a good property account will help you claim on. And these figures more than cover the land tax that we pay on the property. Now onto the income side of things, and we receive a whopping $660 per week on this property, which works out to a 7.6% yield on purchase, which is very bloody handy on a property that's grown by over $300,000 in 2.5 years. This works out to $2,860 per month or $34,320 in income per year. Now, if you take away all of those costs from the income we receive on this property, it is a very positively geared property, meaning that we receive $5,000 per year positive on this property alone, which works out to around $420 per month or just under $100 per week. Now, as I said, this is a pretty handy investment because the property's grown by around $300,000 and it's actually positively geared as it stands. Now, it didn't start positively geared, but after 2.5 years, it's well and truly positively geared and it's still humming from an investment point of view because the capital growth is still going. Now, unfortunately, not all of my properties are positively geared like this one, so let's move on to property number 2. Property number 2 was purchased for $422,000 in Perth, WA in August 2023. The property in question is a 3-bed, 1-bath property on around 700 square meters. It's all developable, which we love, and it's around 13 Ks from the Perth CBD, so it was a bloody great buy. Going off recent comparable sales and bank valuations, this property would be conservatively worth around $670,000 today, which is a gain of $248,000 or 58.7%, which works out to a growth rate of just under 31% per year, which is bloody crazy when you compare it to the average return of the Australian property market, which is 6.8%. And it's done this for the last 2 years. Now, I own this property 100% on my own, and this property is also in my personal name. And the loan amount on the property is $372,000, but I have just under $70,000 in my offset, meaning that I only pay interest on around $306,000. And the interest rate on this loan is is 6.49% with NAB. So let's get into the actual costs surrounding this property. The repayments on this property come out to around $1,655 per month, which is $19,860 per year, which is a much lower repayment than I would normally have to pay if I didn't have that $66,000 in my offset. Because this is an interest only loan, the $66,000 in this offset $66,000 worth of the $372,000 loan, meaning I only pay repayments on a loan as if it's $306,000, which is what we love as investors. The insurances on this property come out to around $1,550 per year, which covers both building and landlord insurance. This works out to $129 per month. This works out to $129 per month, or around $29 per week. The rates and water on this property come out to $2,670 per year, which is around $222 per month, or $51 per week. Property management takes around 9% of the rent I earn on this property, which works out to around $2,500 per year, or $214 per month, or around $49 per week. I've included a $500 maintenance buffer on this property as I did the other one, and similar to the other one, I've had no maintenance in the last 12 months. That's not from me wanting to repair stuff. There's just been nothing that's broken. This $500 works out to $41 per month, or around $9 per week. Now onto the income side of things, this property returns $550 per week, which is a 6.8% yield, which is very solid. This works out to around $2,380 per month, or $28,600 per year. Same thing as before, I haven't included the land tax on this property because I get more back at tax time for holding this property, so I haven't included it in the calculation. Now, if you take away all the costs from the income we receive on this property is positively geared by around $1,440 per year, which is $120 per month, or around $27 per week, which isn't too shabby for a property that's had a growth rate of over 30% for the last 2 years. Now that's the end of my positively geared properties. Now it's time to move on to property number 3 and 4, which are both negatively geared, which is what the majority of properties are when you purchase them. If you're trying to purchase a property in 2025 and want it to be positively geared on purchase, you're dreaming. If it is a residential property that is positively geared straight off purchase, it likely isn't something that I would want to invest in. It's probably an apartment with some crazy yield, or something in a mining area that no one wants to touch. Either way, I wouldn't be scared off buying a negatively geared property as long as it's high yielding and not bleeding too much cash like the blue chip warriors like to advertise. You can still buy properties that are only slightly negatively geared, have great growth, and then in a few years, they become positively geared because we buy in areas of high demand, which means there's a lot of rental growth, which is what has happened with the first 2 properties I own. Now, property number 3 was purchased in Bunbury, WA for $390,000 in February 2024. The property in question is a 3-bed, 1-bath on around 840 square meters, and there's heaps of development potential. I could chuck a granny flat or 2 out the back. There's plenty of precedence and the right zoning, which is great. And if we go off some bank valuations and recent comparable sales, this property will be conservatively worth around $500,000 today. It's probably closer to $550,000, but let's just use $500,000 to be conservative. This means that this property has grown by $110,000, or 28%, which if we go on a yearly return is 23% per annum, which is far above the Australian average of 6.8%. So still a great investment so far. Now again, I own 100% of this property, but this time I opened up a company and trust structure to purchase this property. Now there are many reasons why I've purchased it, but the main one I purchased this property through this structure is because eventually I want to be able to preserve my borrowing power as best as I can, and there are different ways that you can preserve borrowing power when you buy in these entities. If you're looking to do something similar, make sure you speak to an investment savvy broker and a property savvy accountant. Now the loan amount on this property is $364,000 and the interest rate is 6.63%. Now I didn't use any of my own money to purchase this property. I used the equity growth in property number 1 to purchase property number 3. So I pulled out $65,000 in equity against property number 1, which was at a 6.45% interest rate to purchase this property. Now let's get into the cost of these properties. So the repayments on this property, if you add in the loan for the property and also the equity release loan, they come out to around $2,360 per month, which works out to $28,320 per year, or $544 per week. The insurances on this property come out to around $1,520 per year, and this covers building and landlord. This is $126 per month, or $29 per week. The rates and water on this property come out to around $2,800 per year, or $237 per month, or $54 $6 per week. Now, the property management fees on this property come out to around 8.7% of the rent, which comes out to around $2,350 per year, which is $196 per month or $45 per week. We've also included the $500 maintenance buffer, which is $41 per month or $9 per week as well. Thankfully, there also hasn't been much maintenance on this property. I've spent around $350 in the past 12 months, but we'll use $500 for this breakdown. Now let's go into the income side of things, and I receive $520 per week on this property, which works out to a yield of 6.9% on purchase. This works out to just over $27,000 a year in rent or $2,250 per month. Now, if you take away all the costs from the income I receive on this property, it comes out to be negatively geared by $8,500 per year, which means it's costing me $700 per month or around $163 per week just to hold this property alone. Now, you might be thinking $8,500 per year, that's $163 per week, ouch, or you might be thinking that's actually pretty reasonable. And I'd be in the second part. I agree with it being reasonable because it's cost me $163 per year. And if you factor in all the growth I've had on the property, which is over $110,000, it's been well worth it in my opinion. And not to mention, I've bought in a very high demand area, which means that the rent's going to continue to increase in the next few years, which is going to help with my cash flows. Now, you've also got to factor in that my first two properties are well and truly positively geared, so this isn't too bad. But let's move on to property number 4, which is by far the most negatively geared property I have, but I'm going to explain why. Property number 4 was purchased in April 2025. It just settled last week, and I purchased this in regional Queensland for $459,000. The property is a 3-bed, 1 bath on 810 square meters. And if you go off the bank valuations I received from NAB and CBA, the property would be worth around $500,000. But if you go off recent comparable sales, I reckon it could easily be $520,000 to $550,000. But for the breakdown example, let's just say it's worth $500,000, which means I have around $41,000 of equity in this property, meaning I made just under 9% on purchasing this property alone. Now, the ownership on this property is 100% solely me again, and the entity it is in another company and trust structure, not the same as the first one. This is in a completely separate entity because I wanted to keep them separate. This will just allow me more flexibility when I maneuver my portfolio because it's constantly evolving, constantly moving. So this is why it's so important to have a great property savvy accountant by your side. Now, the loan on this property is $338,000 and the interest rate is 6.99%. Now, in total, I've used around $131,000 as a deposit, but again, that didn't come from my own money. That came from equity growth in property number 2, which I've pulled out as equity and I've used towards property number 4's deposit. And the interest rate on this one is 6.49%. Now let's get into the costs. So the repayments on this property come out to around $2,670 per month, which include the repayments on the loan and also the equity release loan. Because you've got to remember, an equity release is not free money. It's still a loan you have to pay back. This works out to $32,000 per year or $616 per week. The insurances being in regional Queensland are a little bit more expensive than normal and they come out to $2,038 per year, which covers both building and landlord. And if you know regional Queensland, this is actually pretty reasonable. I've seen figures up to $5,000 for insurances, so it's so important to check flood zones and make sure you don't buy in the wrong area in these locations. These insurances come out to $169 per month or $39 per week. Again, the rates and water on this property are a little bit more expensive being in regional Queensland, and they'll come out to around $4,500 this year, based on what the previous owners have paid, because I obviously haven't paid this yet. This works out to $375 per month or $86 per week. The property management fees on this property come out to 7.7% of the rent, which is around $1,840 per year, which is $153 per month or $35 per week. And similar to the other properties, I've included a $500 maintenance buffer, which is $41 per month or just under $10 per week. But I did a little bit of maintenance when I purchased the property. That was included in the $131,000 figure. There are a few things that I needed to fix, and that's already been covered. So I don't foresee too many more maintenance issues or anything like that for the foreseeable future. Now, there's obviously going to be some things that pop up. You can't help that as a landlord, but I've put in $500. I do have much larger buffers. I've got around $70,000 in savings in an offset. So I'm well and truly covered if there was anything to go wrong with any of my properties. Now, the rent on this property is $460 per week, but this will again increase as time goes on because it is in a very hot market. This works out to $1,993 per month or just around $24,000 per year. Now, if you take away all the costs from all the rent I receive on this property is well and truly negatively geared, just under $17,000. $200,000 per year, which works out to $1,400 per month or $326 per week, which is by far the most negatively geared property that I have purchased. But let me go through some reasons why I'm okay with it. As I said, I got a pretty great deal. The property's conservatively worth around $500,000 on purchase, meaning I made around $41,000 on the purchase just by buying the property. Now, unlike the other properties, this isn't going to be a long-term hold for me. I'll probably hold this property for 12 to 24 months. The area I've purchased in will do another 15 to 25% quite easily this year, if you ask me. Now, the property also does have some value add potential, so I can do a lick of paint, I can recarpet the floors, and I can just tidy up the house a little bit, and this will increase the value even more. Now, it's not a flip because I'm not a flipper, I'm not one bit handy, but it is a small renovation I'll be looking to complete prior to selling the property. So what I'm banking on is some short-term growth for this property. I'll bank $100,000, $200,000 and I'll move it on to the next property. Now, unlike buying in your personal name, the capital gains tax implications are much different in a company and trust structure. I'm not going to go into all the details because I don't want to get caught up giving financial advice because I'm not an accountant and I don't want to give you the wrong advice. So make sure you speak to your accountant so that you're 100% aware of what the CGT looks like and what the implications are. So if I hold this property for 1 year, that's going to be around $17,000 that it costs me to hold. Obviously, the rent's going to increase by this time next year, so it's not going to be as expensive. And after around 2 years, I'm going to be looking to get rid of the property anyway. So if it's $17,000 this year, and let's say it's $13,000 the year following, that works out to around $30,000 that's going to cost me to hold, which is less than what I've made on the purchase. And not to mention, I'm hoping to see around 15 to 25% of growth in this year alone, and then probably a decent return the next year. It's not just going to fall off a cliff. So I could easily see around 40% of growth if it continues the way I see it happening, which in my opinion is going to be well worth the purchase, and it's going to allow me to move into the next properties I want to purchase in the portfolio, which will be longer term holds. This definitely isn't a strategy that I advise most people to do. I've now purchased 4 investment properties. I work at a property investment firm and this is my life. So it's not for everyone. This is a more advanced strategy. The buy, hold, and hold forever strategy is more suitable for most people. But if you want to build a larger portfolio quite quickly, you will need to be able to move on properties quicker than you normally would, which is something I'm totally okay with. Now that brings the total portfolio to be negatively geared by $21,500 per year or $414 per week. And I'm currently saving around $1,000 per week after all my expenses are paid for. So this means that I've got a buffer of around $600 per week on the property, and not to mention the $70,000 that I have in the bank just in case. So I'm pretty solid from a cash flow perspective, and to hold over $2 million worth of property for $400 per week, it's a pretty good investment if you ask me. Because let's say that my $2.045 million worth of property returned 10% this year. And that's being conservative because if you look at my returns, I'm buying in the best areas and I know there's going to be that growth. But let's say that this property portfolio only returns 10% this year. That's around $200,000 of growth, and the property portfolios cost me $21,000. Now, if I have to spend $20,000 to make $200,000 in growth, I will do that every single day of the week. Now, if you like this video and you want me to do more in-depth breakdowns, or there's some other topics you want me to cover, make sure you comment below and please subscribe. That's the only way I know if anyone's interested in what I'm posting.